All right. Good morning, everyone. We're going to give everyone about 30 seconds to join. All right. Well, good morning. Welcome, everyone. Thank you for joining. I'm Wes Barnes, Chief Operating Officer and partner at Hightower Great Lakes. Today we have some panelists, and we're going to talk casually about inflation, growth, investments, and just about the investment strategy team at Hightower in general. So thank you again for joining. I want to introduce Stephanie Link. She is our Chief Investment Strategist and Portfolio Manager at Hightower. She is also leads and heads up the investment solutions team at Hightower. So Stephanie, thank you for joining us. We also have Don Stellin, who is a financial advisor at Hightower Great Lakes. And we have Samantha Pietruszynski, who is an associate wealth advisor at Hightower Great Lakes. So thank you all again for joining us. And just a quick note, so we do have the chat feature available. So if you have questions, you can put questions in the chat and we'll try to work them into the discussion. If not, we'll also have some time at the end to look through those. So feel free to put any questions you have in the chat feature. So Don, I will kick it off to you to kind of start the conversation.
Okay, great. Thanks, Wes. And Stephanie, it's great to have you here. Welcome.
Thank you. Thank you very much.
We appreciate all of your insights on CNBC and then internally with Hightower as well. So to start out, if you could just kind of give us like a 30,000-foot view of the markets currently and your thoughts.
Sure, like the $1 million question. So you started off with a bang. I have to say, if we step back, and 30,000 feet is really where you do have to look, because there's been so much that has happened in the last 18 months, right? We've had unprecedented amount of liquidity, and liquidity meaning we've had fiscal policy put in place, we've had monetary policies put in place to the tune of about 55% of US GDP. Putting that into perspective, our last downturn in 2008, our last financial crisis rather, it was 5%. We put in all kinds of policies to try to help the environment back then. So 55% of our US GDP economy is this stimulus. And I always like to step back for a minute and say, okay, great. We know that there's a lot of stimulus in the system, but believe it or not, it takes about 12 months, maybe even longer, for the stimulus to get into the economy. Some has really gotten into the economy quicker than others, like the paychecks that we're seeing for consumers, but others, still a lot of bottlenecks going on. And so we are just beginning to see the benefits of all of this fiscal and monetary accommodation. And it looks like we're getting more, Don. Looks like we're going to get about $2 to $3 trillion more. I don't know, that's what some of the people are forecasting. I think it's going to probably be a little less than that, but we have two infrastructure packages on the horizon that could get passed. And if Congress got everything in the wish list, or the president got everything in the wish list, it would be about $4 trillion. So even if it's $1 or $2 trillion, still a lot of money, and it's still a much accommodation in the system. And there is a reason why people say don't fight the Fed. Well, you don't fight the global central bankers, you don't fight this kind of money supply sloshing around. And this is why we are at almost all-time highs, right? And we're seeing nice recoveries abound in around the world. And I will say that if you look at the stimulus, what is it doing? It is actually leading to better economic growth, which is exactly what they wanted, right? So you have above trend line growth in GDP, right? We're going to grow probably something like 7-8% this year alone. Just to keep it into perspective, 2% is your historical average, right? So we're going to grow 7, 8, maybe 9% this year in GDP. Next year, I still think the stimulus is going to be into the system, and we'll see something like maybe 5% in GDP growth. Really good growth. And that is going to translate into a little bit more inflation, right? I think some is transitory, and we can get into all that if you like, mainly on the commodity side. But I think some of it is not transitory. And that's where I mean on the wage side. We are seeing wage prices go up dramatically. We can't get people to go to work for whatever reason, right? So is it the paychecks? Is it that they're saving more? Yeah, they are saving more, by the way, and it is the paychecks, but it's also the fact that there's these bottlenecks in the system. I look at something called job openings, right? And job openings around the country right now are running at 9.2 million. I mean, this is so off the charts of records that I have ever seen in my 30-year career. So there are plenty of jobs to be out there to be had, but you can't get the workers into the stores and into the jobs and into construction and all this other stuff. So you are seeing wages increase because companies actually have to raise prices to get the people to come in. So in the last couple of data points that we've seen in terms of wages, we've seen the non-farm payroll numbers. These are the job report numbers that come out every month. And I don't want to get too wonky, but average hourly earnings, what people are making for the last 2 months, are up substantially. So it is confirming what we're seeing on the wage front. Why do I focus on wages within inflation? It's about 70% of inflation is wages. And that's pretty sticky. I think it's hard. And I don't know, I'd love your thoughts on this, but I think it's very hard once you raise prices to then roll them back, unless you're going to head into a recession. And I don't see a recession anytime soon. Then you're going to ask me, why am I so concerned about wages? Shouldn't we be rooting for higher wages? Of course we should be rooting for higher wages. That's what we want. We want consumers to really feel like they're being taken care of. They feel good. They're worthwhile. What I worry just from an investor point of view about corporations, how do they handle that, right? They have to then raise prices to offset if they're going to increase wages. So we just look at on the margin, things are a little more challenging for corporations. And again, that's what I do for a living. I pick stocks, I pick markets, I try to figure out where there's best value. But it's good for the wage pressures are good for the consumer. The consumer is 70% of US GDP. So we're rooting for the consumer. And oh, by the way, they're saving a tremendous amount of the money that they're getting in the door. We're at a savings rate of over 25%. It got as high as 29% a few months ago. It's now at about 25%. The historical average of savings is 5%. So if you just got back to the kind of the norm, that's $2 trillion of potential pent-up demand from the consumer. And so I step back, I look at the economy is growing above trend. We have a little bit of inflation, not all is transitory, but guess what? We also have record low interest rates. And so without sounding so Pollyannish-like, I feel like we're in Goldilocks in a way. And that's positive for what we call risk on assets, which really is another way of saying equity assets, right? And you can pick and choose, and we can talk about sectors and where we want to be. But I think having the economy in a good spot with a very dovish Fed, who actually reiterated his dovishness yesterday, I think kind of it's all systems go. Now, that being said, what does this mean for how we invest? We look at profits, because stock prices follow profits, and profits could rise as much as 40% this year. Analysts right now are at about 25 to 30% growth year over year in earnings. It could be as high as 40%. And this is why this is a tailwind. All this liquidity, better economy, inflation, that's okay. We got to watch it. Low interest rates, better earnings. You know, this is why we are where we're at in this part of the cycle. Are we like mid-cycle? Are we getting later cycle? Probably. But that doesn't mean you all of a sudden have to sell everything and go into cash. You certainly wouldn't want to do that. You just want to be very diversified, and that's kind of the way we look at things.
Yeah, those are some great points, Stephanie. And one thing that we're hearing about lately, and we're hearing GDP estimates of about 8% for the year. How does that play in? And we've heard the term peak growth a lot. Are we at peak growth right now? What are your thoughts on that?
Another really good question. And that is the debate right now that's going on, quite frankly. It's, are we at peak growth and what do you do about that? I think we are at peak growth. I really do. But that doesn't mean that I think we're going to decelerate materially from here. I think all this liquidity that's in place will lead to very much continued strong growth, above trendline growth. So I hear everyone saying, oh, you know, so I look at manufacturing a lot. PMIs, Purchasing Managers Index. It's just a nice way of looking at surveys that show how strong the manufacturing part of the economy is at. And PMIs, oh, well, they're at peak. And when they peak, then you have to start selling everything and get more defensive. I can see for the next 6 to 12 months of PMIs remaining very strong. A, demand is very strong, and B, we have supply constraints. And that has been a big surprise to corporations and consumers. And so I do think you're going to continue to see, it's going to take a while to get these bottlenecks fixed, right? So I talked to a couple of semiconductor companies, semi-cap equipment companies. They have said to me, well, Stephanie, how long do you think it takes to build a manufacturing plant? So if we're at capacity constraint, how long do you think it takes? And I'm like, I don't know, like 2 years. And they're like, 2 years at the best case scenario. He's like, we can't, and some of them, it's been a couple of different CEOs, they're like, we can't even get people to help build this stuff because we can't get the workers to come work. So it's like this whole thing, it's like a treadmill. And I do think it will continue. I think the growth will continue, even if we have seen peakish kind of growth, which is a really good thing. As I mentioned, I worry a little bit about on the inflation side, on the wage side. But if I think about it and step back, consumer 70% of the US economy, we talked about that. They're doing a really good job in terms of savings, in terms of wages, in terms of personal income. All that is amazing. Home prices are at record levels. Home prices today rose for the last month up 18% year over year. People feel good about the homes that they own. You can't find a home, you can't buy a home because the supply is so little, but they feel good if you own one. You feel a little better that, you know, your net worth is actually a lot higher. So the consumer is good. Manufacturing, which is only 12% of US GDP. Well, I always look at it as like this. Manufacturing is doing well, as I mentioned, these PMIs and these ISMs and all these wonky things like durable goods. And those are all of these indicators that I look at. And they're all flashing still very strong growth, sustainable growth, because within these reports, you kind of get some clues like new orders, right? If new orders were falling within one of these reports, I would start to worry, right? If in business intentions were falling, I would start to worry. They're not, they're actually accelerating. So one other thing about manufacturing, there's a multiplier effect to manufacturing in the economy. While it's only 12%, as I mentioned, of US GDP, for every one job created in manufacturing, 7.7 jobs are created around it. So why do we think that we're actually really focused on the infrastructure side and this infrastructure package, and why both sides of the aisle are supportive of infrastructure? It's because one way to get the 9 million people that are still unemployed to be employed is to focus on the manufacturing side as well, because you can really get those numbers down substantially if you can get them into the workplace. But that's another story.
And Stephanie, I'd like to actually kind of touch on the point when you mentioned wage pressure and how that is being caused by inflation. We work with a lot of small business owners. You know, you mentioned there's jobs out there, but you're seeing over, you know, I think down the street, you know, there's signs where people want sign-on bonuses and how to incentivize people to really work. Can you touch on, you know, how that wage pressure caused by the inflation can impact, you know, smaller companies and some of the companies that you're really seeing that impact in the economy going forward? Yeah, no, I mean, look, it's spot on, the right questions to be asking, right? I mean, it is everywhere you go, help wanted. Right. I went to an advisor meeting in person last week, my first one since I've been at Hightower. And we went to this restaurant with about 20 of us in Connecticut.
And I walked in, and naturally, because I always ask the business owners everything, I'm always like, how's business? What's going on? What's happening? The analyst in me always comes out. So I asked the owner, I said, how is business, and how are you dealing with kind of the wage sort of thing and getting people in the door? And he said, I stopped taking reservations because I only have 6 people working in this restaurant. And this restaurant was huge and it was packed. And yeah, it took a really long time to get service. And you know, we're kind of all anecdotally kind of feeling it, right? It's across the board. I'm sure, Samantha, I'm sure you've seen it done, Wes, I mean, all of us have seen it. And it's a real issue. And so this is why, though, we still have all this stimulus in place. This is why the Fed doesn't want to start getting hawkish and tapering and raising rates and all that stuff, because we're just starting to reopen. We're just starting to heal. As I mentioned, it takes a really long time for all this to get into the system. We've had a number of companies close, especially small and medium businesses. And so I'm sure you guys and gals all hear that regularly from your clients, that things are tough. Business is coming back, but we can't keep up with demand. And so it's, again, this treadmill. And I just believe it's inflationary. That is not so much transitory, at least for the next year. Look, it can all be transitory, right? It very well could, right? We all get back to normal. We all kind of continue to do our thing. We get more people in the workforce. The checks stop in September. So does that inspire people to go and find better jobs? Whatever the case may be, but transitory for a year to me is not exactly transitory, right? Transitory to me is a couple months and things will get better, but it's being exacerbated by these supply chains that are so disruptive. I mean, I go back to semiconductor companies and what they've told me, and it's like, we don't see the supply chain getting better until well into 2022. Now, maybe they're just being conservative. We want to take everything with a grain of salt, but I do respect their opinions very much. And so all of this is to say it's a really challenging environment for the small, medium businesses, for large businesses, right? And so it's going to be a challenge. We're not out of the woods, but I still think from an investment point of view, and we can talk about investing versus the economy versus the real world, because it's all different, right? But from an investment point of view, I think you still want to have companies that have exposure to the reopen. And on the services side of the economy, we've just witnessed a huge surge in the goods side of the economy, manufacturing, right? We've seen a huge recovery. Now it's shifting to services as we reopen. So I had a stat that I wanted to share with you guys. The TSA checkpoint numbers last Sunday, this past Sunday, best since pre-pandemic. The last 4 weeks, the average is 1.4 million travelers. So we're seeing the recovery. Everywhere you turn, we're talking to companies and they're saying, yes, we're definitely seeing the demand. It's a matter of getting people in the door. And that's the biggest conundrum, quite frankly.
Yes, Stephanie, regarding the transitory nature of inflation or what people are calling transitory, obviously wage pressures you mentioned are rising. We're seeing food and energy prices rising, and those are likely going to stay up for a while. But we are seeing things like lumber come back down a little bit. Could you just speak a little bit more on the transitory nature of inflation here?
Yeah, no, and it is the commodity side that I do believe is transitory. However, what's interesting, Don? So lumber is down from after being up 400% year over year. Oh, it's still up 120% year over year, even with the pullback. So it's like, it's still there, right? And there's a function of definite better demand, but it certainly has been part of these bottlenecks. Across the board though, lumber and copper, steel, aluminum, I mean, they got way overdone on the upside in terms of seeing like the hoarding going on, quite frankly. So as those bottlenecks start to get fixed, that should improve on the commodity side. One thing that's very interesting, which is a different kind of commodity, oil. I mean, oil continues to creep higher ever so gently every day. There's a little bit of a bid every single day. And I don't know, today I heard the fourth sell-side research company say oil's headed to 100. Now, I don't really think it's 100 because I just don't think OPEC will allow it. Once they see the price go higher, they'll just flood the market. And so there is a dynamic of supply and demand within the energy market. But there has been, in terms of energy, there has been a massive, massive drought in terms of drilling, in terms of activity, in terms of CapEx coming down. So it's a little different animal. I also would argue copper is a little bit different than other commodities. It'll definitely trade alongside some of these other commodities that we talked about, but that's also a supply-demand deficit situation. There's only so much copper in this world, and it's hard as heck to get it. And there's only a few companies that are getting it and getting it well and doing it efficiently. And so what do you think goes into an electric vehicle? A lot of copper. What do you think goes into a home? A lot of copper. So it all kind of has a lot, it's all kind of interrelated. So there are certain commodities where I think at some point, maybe they got a little too extended, they come back down. But there is going to be underlying demand that drives the commodity price over time. And of course, you have to think about if the Fed is going to stay dovish, what does that mean for the dollar? The dollar probably stays on the weaker side, or at least it doesn't kind of get away from us in terms of increasing. And a lower dollar is always a bullish signal for commodities in general. So while you're spot on, and to note that commodities have come down, I still think the demand picture is real. Now, when demand starts to fall, when we get back to trendline growth, which one day we will, is that a 2023 thing? Is that a 2024? I mean, the Fed chair basically said yesterday, we're not, and last week, we're not even going to think about it until 2023, maybe 2024. Now look, a lot can happen between now and 2023, 24. I mean, we all know this. We've all been in this business for a really long time. My goodness, like in a month's time, things can change. I mean, just look at last week and what happened to the markets after people got confused about what the Fed was saying. And so I don't want to really bank on, them really changing dramatically until that far out there. But I do think we have some time. And I do think, again, the liquidity is going to be the backstop. And I just mention it one more time. You don't fight the Fed, you don't fight the global Fed. And oh, by the way, speaking of global, so the global central bankers put $100 trillion in fiscal and monetary policies last year alone. And the ECB just last month said that they were going to be more aggressive with bond purchases. So you just think to yourself, whoa, this is a lot of money awash. Maybe we will have to, kind of pay the piper at some point, but for the time being, this is very bullish for risk on assets, as I mentioned. And I look around the world, not only is the US certainly healing, recovering, growing, expanding, but the ECB, the PMIs came in 15-year high this past month. And the economist for the ECB, Chris Williamson, he said the economy in the ECB is absolutely, in the Eurozone rather, is absolutely booming. Canada retail sales were up 57% year over year. Mexico retail sales up 30% year over year in this past month. And even South Africa, they're seeing growth in not only retail sales, but their CPI, inflation, was up 5.2% year over year. So these are things to watch. Clearly, we're against very easy comparisons from a year ago. So you want to kind of look almost back to 2019 and kind of look at an average. But the numbers are still the numbers, and they're pretty astounding, quite frankly.
And Stephanie, we kind of touched on, I know the cost of materials, you mentioned copper, wood. I'd like to get your thoughts on the housing market today. It seems like it's a hot topic amongst our clients, especially those looking to take advantage of low interest rates to refinance or, borrow to purchase a home. But for those selling, it just seems like, they're really getting a hot, price for their home. Can you give a little thought on that?
Sure, no. And housing is very important because, as I mentioned, manufacturing having the multiplier effect. Well, housing is even more. Housing is even greater. There's a huge correlation between housing and autos and auto sales and light vehicle sales in general. You buy a house, Well, we know we got to furnish it, right? Inside. You probably have to do some landscaping outside, which to me is always like, oh, it's like a waste of money, but you have to do it. But then you probably have to buy a car or a truck to get from point A to point B, right? So there's that, number one. So there is a big multiplier effect. What we have seen in terms of housing is inventories are dramatically low. Last April, inventories of homes in general were at about 6. So this is at like the depths of despair, right? When everyone was panicked. The average monthly in terms of the inventories were at 6.5 months. That's the average inventory, right? Around the country. Today we're at 2 months. 2 months of supply. So we have shrunk dramatically. And yes, Samantha, to your point, it is low interest rates, but it also is, and I hear this from a lot of the home builders, it is also millennials finally are buying. And to your point, yes, it's the low interest rates, then you have millennials, and then, oh, by the way, you got COVID. Nobody now wants to live in a city, which I think is the wrong call, quite frankly, if you want to be a contrarian. I think you're seeing rents start to creep back higher in some of the key cities around the country, but you did have massive exodus and people going and actually saying, well, interest rates are low and I want a house and I want space and I don't want to be on top of somebody, even if COVID, we get back to normal. And so you have these massive changes that are happening. And it's sort of funny that you talk about, or you ask about housing. I say to my family all the time, and we're only in my house 6 years. And I'm like, why don't we sell? We could probably get top dollar. And my family's like, well, where are we going to go? And it's true. Where are you going to go? So there's just not a lot of options. Now, that being said, home prices, because there's such limited inventory, home prices on a median basis were up 18% year over year, as I mentioned, on a mean basis in this past month, up 16% year over year. That's big. That you have to watch affordability, because that is going to be the thing that probably crimps things. Now, I will say this, the reason we're at 2 months of supplies, because you can't get, up until most recently, you couldn't get lumber, you couldn't get people, you didn't have this land. There's only so much that some of these companies, public and private, have in terms of land and options. And oh, by the way, it takes a while to build a house, right? So there is it might be pent up demand, but my goodness, I mean, I don't know, we built our house and it took about 8 months all in, right? And it's a long time. So you certainly can do multifamily faster. You can certainly do other kind of homes faster, but there is also a big shortage of kind of that first home buying couple, right? Or family, right? And those kinds of homes. So we hear it all the time. And as I say, I've owned many different home builders, and just to hear what they have to say about the dynamics, what one of the CEOs told me about housing is it's very highly, like I said, it's very highly, there's a multiplier effect, but it's very highly correlated to jobs. So if jobs are going down, that's still a tailwind. So watch those numbers. If they continue, hopefully they will continue to go down. That still means that demand, there's that underlying bid for homes. But look, I mean, it's expensive on the one hand to buy. It's also feels really good if you do own, because you feel obviously that wealth effect. And oh, by the way, that then translates into consumer confidence. And we're at record highs in consumer confidence, right? So it's sort of fun how it all kind of makes sense, and how it all, at least the numbers, are very much confirming all of the things that we're talking about.
Stephanie, you mentioned some tailwinds for the markets. On the contrary, what do you see as headwinds or threats to the equity markets for the remainder of the year?
Well, I think valuations are not cheap. I think that any given day we could have a Fed speak and all of a sudden, who the heck knows? I don't think that's going to be the case, because quite frankly, if you think that there's a consensus at the Fed, I would say I think you're wrong. It's a dictatorship. And Powell is hell-bent on keeping rates low and being dovish. And that's why, in front of Congress yesterday, he went out of his way to be very, very dovish. That's all good. But will they be behind the curve at some point? Right? That's a question I wonder. The other thing that has been really interesting this year, Dawn, is the rotation. So the markets are at highs, right? But the underlying sectors that are working on any given day has been really incredible. So from January to May, the Russell 1000 value index, just a proxy for value, was beating the Russell 1000 growth index by 12 percentage points. So it was really a value sort of year. And let me just tell you, the S&P 500 is my benchmark. 75% of my benchmark is considered growth. So for someone like myself, I went out on the curve in terms of trying to find some value, cyclicals, reopen kind of names that were really left for dead last year. And that's what I was doing last year and into the beginning of this year. But since then, since May, we've had a recovery in growth. And so now value is still outperforming growth, but only by 5 percentage points. So you can see this massive shift. And I think many people, because growth has been an area where you want to have been invested in for sure over the last 10 years, I think a lot of people are caught off guard on the value trade versus the growth trade. And so I think the rotation is almost, as a portfolio manager, almost more important to get right. And you have to be bigger picture and see what you're comfortable with in terms of the macro. But I do worry very much that the Fed overstays its welcome. Again, because I don't think that all of inflation is transitory. So I worry about that piece. But for the time being, we at least have better trend line growth. Better trend line growth will cure a lot, quite frankly, right? And I still think that earnings are going to be good. When things start to decelerate is when it's going to get tricky. And that's a timing thing. And that's sometime next year, I believe, right? Because we're going to get taper. We're going to get maybe we get rates. I don't think so, but we're going to have talk of that and chatter. And the market kind of might have some indigestion, especially since we're up about 85% from last year's lows. So I worry a little bit about inflation. I worry a little bit about the Fed and policy. I worry a lot about deficits, but quite frankly, I worry that for my 14-year-old and not so much for us, because I think that generation is unfortunately going to have to deal with these large deficits. And so therefore you wonder, when is that conversation going to come up? What does that mean for taxes? So there's a lot down the road, but for the time being, I have to be an optimist given all that I'm seeing. Just want to be very mindful that a lot of great news is priced in. So you want to be very diligent in doing analysis on various different companies and sectors and that sort of thing.
Thank you, Stephanie. Yeah, we definitely want to hear your thoughts and perspective on the bond market too. So we'll switch gears here in a second. But before we do that, clients are often telling us that, I'm hearing this. Sometimes we're hearing doom and gloom in the media. We're at peak markets, and because there's so much flow of information, you can hear almost any perspective. I wanted to know do you have any advice or your thoughts on, as a client, from a client perspective, how do you take in all the various views and opinions in the media?
And you know what, I will tell you this. So I'm I'm a CNBC contributor. I will first and foremost be the person that says, turn off your TV. Do not listen, do not watch, especially when there is a deceleration or decline in the markets, because you will have every gloom and doomer on. And I'll never, ever forget it. Bill Ackman last March on CNBC scared the bejesus out of all of us and said, the economy's going to hell. And I'm thinking to myself, my goodness, that's so irresponsible. Now, look, you can think that the market is going to hell, but not when the Fed came in and they tried to really shore up a lot of different things. Things changed so quickly. But I know, look, I have family all in this business doing what you're doing. And I'm sure you guys were fielding all kinds of calls and people were panicked and scared. And that's why I say, turn it off. Listen to Wes Barnes and Don and Samantha and let them, and you guys hold their hands, because you have to think, we're not short term. We shouldn't be short term. If you want a hedge fund or you want a trader, by all means, you want to be in the meme stocks, go for it. Know your risk and reward, but understand what it is that you're looking at. And I'm sure you guys preach this all the time, diversification, right? Not only owning all technology, not owning all cyclicals, not owning all stocks, not owning all bonds, alternatives. I'm sure you have a whole array of ideas for your clients, and you guys are the experts, right? You guys hold their hands and really calm people down when we're in down markets. And oh, by the way, remind people, it's really, really advantageous to buy low and sell high. So while you don't know where the bottom is going to be, I have always been a huge proponent, and I'm not sure about you guys, but I've been a huge proponent of dollar cost averaging, right? And this is because you can't time it all, right? None of us knew. If we could time it, well, all of us would be on some sort of island at this point, right? So I think you really just keep everybody calm. You turn all the media off. You can read things, magazines like, I really like Kiplinger. I really like Barron's. I like the Wall Street Journal. They may be, even the New York Times. I like to read to be educated, but I don't want to be scared. And I think sometimes TV tries, it's like that propaganda stuff. And I know myself, I turn it off and then I show up on TV and I try to be the lone bull out there, or try to look at anything as glass half full, because investing for the long term is bullish. It's very positive.
Definitely.
That's right. Thanks, Stephanie. Switching gears to fixed income for a bit here, what are your thoughts on rates this year, interest rates, 10-year treasury, and the yield curve? What do you think? Where do you see that going?
I tell you, and I've said this for a while now, it's perplexing. It's perplexing. It's like, I don't get it. I don't. And I will say it's the question to ask, Don, because we know the bond market sort of sniffs out things, right? And so, a couple of years ago, when the bond market inverted, everyone said, oh, don't worry about it. Everything is fine. The bond market doesn't know what they're doing. It's all manipulation from the Fed and this and that. Okay, well then 12 months later, we had COVID. And I'm not saying that the bond market could foresee COVID, but they obviously saw a slowing. And so I look at the bond market and yields and I say, wow, what in the heck is going on? We have above trendline growth. We're going to have it for some time to come. We have record corporate profits. We have an economy really that is just starting to reopen and boom and that sort of thing. We have goods doing well, services doing well. So why the heck are we at 145 on a 10-year? Well, there's a couple things. So that number one is a huge surprise to me. I would never have bet that in a million years. But I do think you are seeing a lot of involvement with the Fed, kind of, I don't want to say they're manipulating, because they're not. They're just in there buying, doing what they think they should be doing to keep rates low so that it's good for corporations and the consumer. That's what they're really trying to do, right? And I think, so the short end is really kind of manipulated by or I say it's influenced by the Fed. So is the 10-year, I believe. The 30-year might be more of, okay, we have to worry about the deficits. We have to worry about the infrastructure package that's coming down the pike. And so I think that there's a little bit of that going on. But no matter which way you look at it, QE is distorting the bond market, I believe. However, I am going to remain humble and say it is something that I worry about, because I don't want to not see something that's coming, or I don't want to at least try to anticipate, because that's what the market is, right? That we always look 6, 8, 10, 12 months down the road. Is it telling us something? And I think it's a little too difficult to say that it's telling us something when you've got, $120 billion in bond purchases each month, right? And it's not going away anytime soon. And as I mentioned before, the ECB is doing the same thing and accelerating their plan. The other thing I've heard, and I don't know this to be fact, but I'll just throw it out there. So Japan is the largest US Treasury holder in the world. And I saw a chart. I wish I had it so I could show it to you guys, but I was only showing it to me quickly. But seasonally, for whatever the reason may be, from May until August, Japan steps up their bond purchases. I don't know what that is. I don't know if that's a 401k thing. I don't know what that is. But all I know is it's an amazing chart. It just kind of goes up and then it goes down. And so there could be a seasonal situation happening in rates. And then lastly, look, at the end of the day, we have the highest rates in the world right? I mean, 150s or 145 still, it stinks, but it's better than negative rates. It's right. And so where else do you go? And so I think all of these things have an impact on the bond market, but it doesn't make any bit of sense to me. And I'll tell you, we see a whiff of inflation not being transitory, rates are going to go a lot higher, I think. So let's watch inflation, because that's the correlation.
Stephanie, based on your outlook for the bond market, how have you positioned fixed income in the portfolios that you manage?
Yeah, so that's a good question. Look, I think I get this all the time. Is 60-40 dead? I would say sort of, kind of. The 60-40, the traditional metric or measure. Now, that does not mean all of a sudden you go put 100% in equities. Absolutely not. You use that 40% in fixed income to find other things, right? Is it alternatives? Is it equities that actually act like bonds, meaning they have high dividend yields that have good balance sheets, of course, because we've got to make sure that these yields are covered. Is it convertibles, preferreds? Is it real estate? So to me, I think you don't necessarily want 40% in bonds here. It's very hard for me to buy a bond. Of course, you're talking to an equity gal, so you know I'm not ever going to really tell you to buy a bond. But I would just simply say you want to make sure within that 40% or whatever the number it is that you feel comfortable with, depending on obviously demographics and that sort of thing. Just want to make sure you diversify within that. I wouldn't say go all out and buy high yield, buy junk. I mean, that doesn't make me feel good, comfortable, right? Especially if I'm a long-term investor. But maybe you pepper it with various different things. But I don't know, you guys probably feel these questions heck of a lot more than I do. And I mean, it's like you kind of have to scratch your head. And one thing I get a lot is, okay, well, maybe I should start looking at alternatives, right? They're much longer duration. I said, but they're much longer duration. They're not liquid. So it depends on if you need that liquidity or not. But certainly that has been a very hot topic for us within our group in terms of what we want to recommend and that sort of thing. But you know, this goes back to you guys talk to your clients every single day. They are lucky to have you. And you guys can figure out what's the best solution for them. And again, diversification across the board, dollar cost average across the board. And I think over the long period of time, your clients will be just fine.
Yeah. Stephanie, you touched on earnings a little bit earlier. What's your outlook for earnings through the end of the year?
Yeah, so I am beginning to think we're going to see something like, so the street is about 25% earnings growth for the S&P 500. I'm beginning to think we could see something closer to 40%. And here's the reason. So over the last 18 months, companies have been cutting costs, restructuring, doing anything that they could, raising debt, given the low yields in the bond market and that sort of thing, but raising capital and that sort of thing, really fixing their balance sheets and doing all that they can. And so believe it or not, margins have actually stayed pretty stable. So now fast forward to where we are, we have better demand. So we had no demand. Nobody had any demand anywhere, right? No companies, other than maybe the staples companies, because everyone was buying so much Clorox and tissues and toilet paper. But most companies did not have really great demand when we hit the kind of the depths of despair last year. And so we've been gradually recovering. So now you have these very lean and mean companies that have now begun to see better demand. And what I like to call is when you have better demand and margins are strong, and they're staying strong because we know they now have pricing power, you get positive operating leverage. And so that's what I think is happening here. You're getting many more companies that are starting to raise prices and to offset the wages that we talked about, but they're also raising prices because demand is there. And so I think they've done a really good job at navigating as best they can. Now, some industries are better than others, right? I mean, you're going to ask me like airlines, do you want to be involved in airlines? Well, airlines can't even get their act together in a bull market, let alone the bear market. So no, you don't necessarily need to go there, but there's other ways that you can find really great technology companies, really great industrial companies, materials companies, consumer products companies. In fact, every one of the consumer staples companies last quarter, every single one that I listened to, and I think I listened to about 20 calls in terms of earnings calls, Every one of them said they were raising prices, everyone. So unfortunately for you and me and Samantha and Wes and all your clients, we're going to see higher food and energy prices, right? I mean, it's just what it is. So hopefully we're all saving a little bit more so we can afford all these things. But at the end of the day, it does translate into pretty strong earnings. And yeah, sure, we're going to tail off next year. We're not going to do 40% up sustainably, but we will do probably double digits next year too.
So related to that, in the portfolios that you run, what are your overweights right now?
Yeah, so I got a little dinged up last week because I own quite a few economically sensitive companies and quite a few reopen plays because I still feel, and so that tends to kind of skew me a little more value. My mandate is large cap core, and that just means I can own a blend of value and growth, and I can tactically move where I feel we want to be. And so for the last several years, I've been leaning more growth. Well, about last summer, I just kind of felt like the economy is going to gain momentum. We're going to reopen eventually. Many companies, especially blue chip companies, got hit very, very hard, baby thrown out with the bathwater. And so I decided to be more proactive and bought a whole slew of these other names. So what does that mean? What is that? What is economically sensitive sectors? It's financials, it's materials, it's industrials, it's parts of technology, more on semiconductor, semi-cap equipment companies versus software. So I own a whole slew of them. I also own a fair amount of discretionary because, as I mentioned, I think consumers in better shape than people believe. And I think there's such huge pent-up demand coming. And it's already coming, right? As we talked about before, but I think that that's still going to be a theme. So I have a big slug of that. My biggest overweight is probably financials because they're still very cheap. Industrials are, I think there's a lot of different industrials that you can own. You can own aerospace and defense, you can own machinery, you can own logistics. There's a lot of ways to play an improving economy in that space. So those are the two areas that I'm probably the biggest in. I do own a few copper companies, and I do own some materials companies that offer good dividend yields. So I'm trying to find a hodgepodge within the reopen recovery. I can't even tell you how many like gaming and restaurants and this and that I have exposure to. Now, that being said, I also still do own secular technology companies too. And I'll tell you why. Even though they're expensive and they're crowded, although they have pulled back a little bit, I do think you want to participate where there's very strong total addressable market opportunities, right? So AI, for example, is going to be a $1 trillion total addressable market industry by the end of the decade. Cloud, same thing, $1 trillion. How about retail e-commerce? We all know the big behemoth. I'm not mentioning any names, but we all know the big behemoth, but we also know the trend in retail e-commerce. Well, that was a $3.9 trillion total addressable market in 2019. That's going to $7 trillion by 2026. Well, we want to have participation there, right? Wearables, same thing. EV, same thing. You just want to make sure when you are buying some of these technology companies, there's earnings, they have strong balance sheets, there's ample free cash flow. It's the high flyers that bother me because I can't help you when the market decides to correct. I can't then say, oh, but the valuation is supportive of XYZ, or the dividend yield has gotten to 4%, which is attractive. If you don't have earnings, you're at the mercy of whatever momentum is out there. On the upside, you make a lot of money, but on the downside, you make a lot of money. And I got to tell you, some of these high-flying technology companies got nailed over the last couple of weeks, months. And I think I would have just been a nervous wreck if I owned any more than 2 or 3 of them. That's about what I would, out of a portfolio of 44, I own 2 or 3 that give me a headache. But again, I'm participating in what I believe is going to be strong growth, and they will eventually grow into them. But you do not want to have a whole portfolio of meme stocks, for example, right? That's crazy. In my opinion, that's crazy. It's not the way I invest, but I'm sure you have clients that ask you all the time about them too. So, but I think at the end of the day, so I lean a little more value, I lean a little more cyclical, but I do feel that there's a big appreciation for technology that you definitely want to have exposure in. And at any given point, I'll be tactical. I have a very long-term perspective. And in fact, as I mentioned, I have 44 companies in my portfolio. And on average, I've owned them for 4 or 5 years. So I don't want to do all this homework on stocks and companies, and then all of a sudden, I made 20% and now I'm going to sell. And that's not my thing. I will be very patient over the long term. I bought something because I liked it and there was a reason. And if the story changes, well, that's one thing. But my process is to buy number 1 or number 2 in each industry, blue chip, good balance sheets, great management teams. A bench it's incredibly important to have good people around you. I love when CEOs have people around them that are even smarter than them, or at least they'll admit that. It's great to just like your team, right? You want to have all the smart people, smarter than you, so that you guys can really shine and flourish. And I know I've done that, at least in the department that I've created and built out. So, but I will also say one last thing in terms of companies and sectors. I think it's very, very important, for someone that's running a portfolio, not your clients, but, and I'm sure you'll agree, to meet management teams, to listen to conference calls, to do the due diligence. I have met every single CEO of the companies that I own in my portfolio. I would never not, because I think it's that important. And long time ago when I worked with Jim Cramer, that was one of the things he taught me. And I thought, well, that's crazy. Why do I need to know a CEO? Well, let me tell you, they have a track record, right? And execution is everything. And even if you stumble, if you have a good track record of recovering, they'll make money in the long run.
Great. Yeah. And, we talked about views and outlooks on sectors, but, we oftentimes in discussions with clients, we're talking about, how we're diversifying across asset classes, large cap, mid cap, small cap, international, et cetera. And can you just share a little bit, how you and your team, how you develop outlooks on these asset classes and allocations around those?
Yes, I mean, look, I think, and you guys have been a wonderful supporter of our multi-asset strategies, right? And that's what that is. It combines equities and fixed income and some alternatives, ETFs, active management, and it depends on what your clients want in terms of an allocation, right? So, you have many different clients with so much money and they're so important, and you have to talk to every one of them, right? Because that's what, it's what you do, B, it's your fiduciary responsibility, but C, you want to make sure you get them in the right allocation so that they can sleep at night. Let us run portfolios not sleep at night. let Great Lakes not sleep at night, but that's okay, because that's why we do what we do and we like what we do, and we're good at what we do, right? So, but I do think that getting the right allocation per client is important, and that's what you guys do so well. You talk to your clients and you really understand what they want, what their goals are, and their aspirations are, if they have children, what they want to leave them, all kinds of things. I mean, I could never do what you do. You guys are amazing in terms of the breadth and the depth of what you can explain to people. What I can do is I can put portfolios together for you in the multi-asset. I can also put portfolios together for you within equities. So we have large cap core, as I mentioned, which is what I run. We have a dividend growth. We have a large cap value. We have an inflation surprise portfolio, an ESG portfolio. So we can do customized things in ESG, in the equity side. Fixed income is kind of plain vanilla. I have always said I do not want to create alpha via fixed income. I just want to, again, sleep at night. But that brings me back to the multi-asset portfolios that you guys are very much involved in, and we appreciate that very, very much. And we do a real rigorous due diligence in terms of trying to find what are the right managers. So we have like ETFs, and then we have active managers. And on the active managers, we really try to get it right in terms of where we want to be in the world. We don't want to just be in the US. Obviously, we want to diversify. We do want to have international. We do not want to have more than 5 or 10% max in emerging markets, because that's a very volatile market. But we have all different sleeves that you can invest in. And that's why I can feel good about, hey, we like a manager. How much do you want to do in international kind of thing, right? And if you believe in a recovery, and you believe, like I do, in kind of the cyclical parts of the economy here in the US, believe it or not, EM will trade with it. Small caps will trade with it. We call that kind of the same factor. They all kind of trade at this on the same theme, but we don't want to have 100% of the same factor, right? Because that's not diversifying. So we work very hard at meeting all the managers. I have someone who I recently hired in December, Mike Shea, and he is making a huge effort in terms of meeting every single active portfolio manager, where we want to be, where we want our allocations. But I still feel at the end of the day, the US is it might be the most efficient, but it's also the most liquid, and it's also the most transparent. So Europe might look cheap. Europe always looks cheap, trust me. They don't have the margin upside that the US has, and Asia, PAC, might look attractive because there's a lot of growth and there's a lot of alpha generation potential. Well, they don't have transparency, so there's a reason. Developed economies are developed economies, so you're going to get what you get. So you kind of have to know where you want to be, and I think you guys have done an amazing job throughout all of your clients, and in terms of what you're doing on the multi-asset strategies, you're putting your clients where they need to be. And rest assured, we are doing homework every single day on the managers that we have in these portfolios, as well as are the ETFs the correct place to be.
Well, we're getting towards the end of the hour. I know we've hit you with a lot of questions, Stephanie, so we really appreciate that. Any just final thoughts before we wrap up on everything that we covered?
Well, thank you. I don't know if you could tell, but I could probably go another 2 hours on this because I'd love to talk about the markets. I think your clients are in great hands. You're doing really wonderful things for them. I see the portfolios that you're putting into, in terms of the money you're putting into our portfolios, and I think everything that you're doing is absolutely brilliant. You guys have the relationships. Let us get the gray hair. And I think overall, stay patient, stay diversified. And I truly mean that. And I started dollar cost averaging. I've mentioned this now a couple of times. I started that when I was 21 years old, when I graduated college. And my father was like, okay, you got to put a little bit of money in the S&P 500, the Vanguard index, just a little bit of money every month. You're 21, you're really young. I'm like, I have $10 a month extra, Dad. And so he said, I don't care, just keep doing it. And you know what? To this day, 30 years later, I still do it, right? So it's part of a strategy, but you guys have your own strategies for your clients. And I think they're lucky to have you, and I'm lucky to know you guys and work with you. So thank you.
Perfect. Well, thank you. And again, I want to thank Don and Samantha as well for participating. And Stephanie, thank you again. And thank you everyone who joined today. We will send a follow-up email after this with our information if you have any follow-up questions or want to get in contact with us. And we'll also have this recording available. So thank you, everyone.
Thank you.
Thanks, Stephanie. Appreciate it.
Thank you.